wait 2 more minutes as I still see participants coming in, and then we'll. So good afternoon and good again from myself from Brussels, Gaetano Vivo. I'm with DG ECO and the team leader for the Prevention and Preparedness Program. I will summarize briefly what I just said. We're very happy to have you on today for this second of a series of 3 modules, where today we'll focus on financial risk and basically taking into applying the concept that we learned during the first session that was looking at modeling risk. Today we apply those concepts to macroeconomic impacts. We have a great team of experts, which I will present you in a moment, just after having reminded you that this session is being recorded. The first module, the first session that we had last Friday is already available online, and I would kindly ask Judith to please put the link in the chat box. Please also use the chat box for any questions or comments you may have, and I will do my best to address them to the speakers. Looking at the speakers, in addition to Samantha, who you already know, I'm sure, because she's one of the lead authors of the study that we have done with the World Bank. She's our lead specialist in risk financing. We have a team of we have 3 new experts today in our course. So I'll be pleased to introduce them, starting with Maria Martvida. Maria is a specialist of disaster risk assessment and is a lecturer at Stanford University. She works to integrate disaster risk information into strategic decision making and planning. Maria is also one of the founders of the Stanford Urban Resilience Initiative. So we're very happy to have you with us today, Maria. Then Christina Stefan is a specialist in disaster risk finance, and she specializes on design of risk transfer products such as cat bonds, parametric insurance, and several other risk transfer options that she will mention today during her presentation. And last but not least, Daniel Pele. Daniel is a professor at the Department of Statistics and Econometrics at Bucharest University, and also works for the World Bank and the European Investment Bank, based in Romania. I apologize again for the little glitch and I not realizing that I was muted, but I will hand now to the floor to Samantha so that we go straight into the content of this second module. Over to you, Samantha, sorry.
Thanks ever so much, Gaetano. Appreciate you rerunning through your opening remarks there. So what I'm going to do, just very briefly, I'm Samantha Cook. I work on the Crisis and Disaster Risk Finance team, and I'm based over in Washington, DC. So if I mess any of my words this morning, I apologize, but bear with me, I'm still drinking my coffee. What I thought I'd start with, we had an excellent session last week, and I thought it would be useful just to give a very quick recap of some of what was discussed last week. So here, what you can see is essentially Stuart, he gave an excellent explanation as to risk assessment, how you do it, where its value lies. And this session is going to build upon that and really demonstrate how you apply the outputs of risk assessment and risk modelling work. So again, very briefly, if you look at the triangle on the right-hand side, you've got three facets of risk. You have your exposure, your vulnerability, and your hazard. And ultimately, your risk is a function of those. The blue text on the left, this actually goes through all of the work that was done through the series of reports, because this component, the risk assessment component, actually fed into two other sections. But ultimately, what it was really trying to do was quantify the level of risk in each of the EU member states to both flood and earthquake risk. And I will be that specific because it is important that if you only remember one thing, we're looking at flood and earthquake with the risk assessment. Essentially, to conclude on this slide, I like the quote on the bottom right-hand side: disasters are the outcome of continually present conditions of risk. So these are the three reports. Very briefly, just to give you the overview as to how things fit together. Ultimately, what we were trying to do was to be able to quantify how much risk you have, first and foremost. That was Stu's presentation last week. This session, what we're going to try and do is quantify what that risk means in both fiscal terms and economic terms. So basically what it's going to cost you as the government going forward. We find that often this helps, it resonates with people, because once you start seeing dollar values attached and the impact vis-a-vis your GDP, it starts to resonate a little bit better. The next session, session 3, what that's actually going to do is, again, using the risk assessment work conducted by Stu, that's actually going to walk you through some benefit cost analyses that were done to try and demonstrate the value, so that added return that you get from investments in disaster risk reduction. So today, headline statistic is essentially that we found from this analysis that major disasters create a liability that can exceed 17% of GDP each year. Basically, what this means is that there's a 10% chance in any given year that the EU has an earthquake and flood, so two events that will exhaust the existing finance, and that essentially 96% of the liabilities generated from that are covered from ad hoc financing. And as we get through today, we'll demonstrate why the ad hoc financing is important. Often ad hoc financing is a more expensive way of being able to financially respond to disasters. So this, just to conclude, to give you the big picture as to how we're looking at this today, we've got the catastrophe modelling sitting in the middle with your estimates of your average annual loss by country and also at the aggregate level. We took the outputs of this and we used it for two other sets of modelling analysis. So on the left-hand side, we look at the economic impact. What is the impact on GDP? What is the impact on the fiscal balance? And Maria and Dan will walk you through that later on this morning. And then on the far right, once we understand what the impact is on the fiscal balance, we then thought it would be important to actually look and see how much finance the EU and the member states currently have in place to be able to finance that risk. And then essentially we looked at the funding gap vis-a-vis financial instruments and the amount of finance that you hold in them versus your potential losses in the future. So that's a very quick overview as to what we will do. Before we start getting into the more complex modeling aspects of the work, first and foremost, I want to say thank you to all of you who responded to our survey. So Judith kindly sent out a link to our survey, which we've used the outputs of to feed into our case study, which we will get to towards the end of this session. But first and foremost, I didn't want to neglect saying thank you to that. So if we take a step back, I'm going to run through the fundamentals of disaster risk finance here. So I get the easy job this morning, essentially. So what I really want to present here is ultimately what is disaster risk finance conceptually. What is it? And then we can discuss how it works in practice. So essentially, when we're talking about disaster risk finance, we're talking about protecting livelihoods and development. We want to look at, again, that funding gap analysis, look at the existing financial resilience you have, how much you have on your books. We do this across all aspects. We can do it for governments at the national level, at the subnational level. We can also do it for businesses, for households, essentially trying to get an understanding as to where the risk is. We can also do it sectorally. On this slide, we highlight farmers. We can also look at other sectors as well. Essentially, what we want to try and do is build sustainable and cost-effective financing solutions for any future shock that may arise as the result of a disaster. So when we start talking about resilience, we really look at three aspects of it, and we view these as mutually reinforcing. So we look at physical, social, and financial resilience. Very much this featured throughout our three reports. We view this as key because if you're only doing one element, that's great. You have to start somewhere, but realistically, we should be aspiring to cover all three. So if you reduce your physical risk, for example, you should see benefits of that feed through into your financial resilience. For example, if you retrofit a school building, you're then seeking insurance for it. If the building is in a fundamentally better condition, you should see that come through in terms of the premium that's charged. It may also take an asset from being uninsurable to being of insurable quality. That financial resilience can then serve to further your social resilience. So if, for example, schools are also used as an evacuation centre during an event, knowing that the school is in a better condition, it's fit for purpose, this can also help. We also highlight on this slide shock responsive social safety nets, so cash transfers to people. This is another way you can consider it. My favourite takeaway from this slide is really that when I started working on this quite some time ago on disaster risk finance, no one was really talking about it. People spoke about disaster response. Now we're trying to look more at the preparedness and prevention aspect, and that's where disaster risk finance becomes a good fit. It's now become, because of this, it's now become part of what the ministries of finance look at in terms of being able to boost financial preparedness and ultimately having some prearranged finance that can release funds when needed. And that is the important point, and that makes your disaster risk financing strategy cost effective. It releases funds when needed. This is where disaster risk finance fits into the big picture of disaster risk management. Again, just emphasizing the finance itself is one small piece of the puzzle. People get very excited about finance. They get very excited about the prospect of interacting with the capital markets. However, we like to just make it very clear that ultimately it's only one of the 5 pillars represented by the GFDRR pillars here towards comprehensive disaster risk management. So Pillar 1, the risk identification. A lot of this is what Stu talked about last week, being able to identify and understand that risk. We feed in somewhat later in the picture in terms of financial protection, but very much leverage all of the other pillars. So we complement, but we don't replace risk reduction and resilience measures, and that's really important to know. So we talk about 4 principles of disaster risk finance. Essentially, my favorite one on this is actually the timeliness of funding. So again, having your pre-arranged finance to release funds when needed, but recognize that not all funds are needed at the same time. So for example, what you can see from this graph is that you need different amounts of finance for different durations of time, and depending as to what you're trying to finance. So if it's relief, you need a lot of finance quite quickly, but you don't need it for a very long period of time. Whereas for reconstruction, you will need the money somewhat later once you've started to basically recover from that shock, but the reconstruction activities, they will go on for much longer, and you will need much larger amounts of finance to do it effectively. If you go underneath that to disaster risk layering, you'll start to see some of this come through today, particularly when Christina is speaking. No single financial instrument can address all of your risk. If it did, it would be so expensive that it would not represent a cost-effective approach. Again, important to bear in mind that having different instruments, for example, if you kept everything in cash, that would be an extremely expensive way of managing your risk, and you would also jeopardize investments in other projects which could generate economic return. Disbursement of funds, how money reaches the beneficiaries is as important as where it comes from. So again, goes back to that point, what are you trying to finance? So having an effective disbursement mechanism, whether that's a social protection system or whether that is being able to disperse from your national reserves, these are things which need to be thought through. And again, if it's reconstruction, who should the payout go to? If the government at the federal level has paid for the premium, should the federal government get the premium for the coverage of those assets, or should it go direct to those in charge of the operations and maintenance of the asset itself? They may or may not be different people. Data and analytics. This I cannot enforce enough. Sound financial decisions require the right financial information and data. Again, think back to Stu's analysis, where he was demonstrating that how risk assessments, risk modelling, ultimately how that helps generate a picture of what your expected loss could look like for events of different magnitudes, and that's very important for the financial instruments themselves. So this is just kind of a quick repeat of what I was just discussing. So the timeliness of funding, what are you financing and when do you need it? There are some trade-offs to consider when you're looking at different financial instruments for this. So we tend to get very excited about the parametric insurance, which very much leverages the risk modelling work. It's very quick, but what it won't do is it won't cover your full loss. So if you're looking for some form of budgetary support to act as a top-up to government budget, parametric insurance, it works quite effectively. On the other side, if you're trying to finance the reconstruction, indemnity insurance, it takes time to pay out, and the reason it takes time is you will have a loss adjuster. You will have someone that goes out and physically looks at the assets, assesses the repair. It will be an engineering report ultimately, and that report will determine the size of the payout vis-a-vis the reconstruction that's needed. So essentially what you want to look at, as articulated in this diagram on the right, is the speed, the reliability, and also the cost. So for example, you could have a line of contingent credit. It works quite quickly. Bear in mind that will impact your future liabilities, but it's there for when it's needed. We also have the example of Fondon highlighted, but I talk about that a bit later on, so I'll skip that one for the time being. So again, these are the instruments. So we talk about a layered approach to risk financing here at the bank. So essentially, we look at this in terms of the severity of the event and the amount of finance that's needed. So at the bottom, ultimately, this is your source of finance, which should be closest to cash, to finance the most regular, most frequent events. At the other end, in the orange box, is the market-based instruments. This is for your less frequent but more severe events. So this would be for extremely large events. You could think about flooding, which happened this summer, having some form of risk transfer for that could be beneficial, again, to be considered vis-a-vis the risk profiles. Essentially, it's just worth keeping in mind that these different financial instruments, they will all have a cost attached to them. This is why for different types or for different magnitudes of risk, we advocate for having different instruments in place. The risk transfer at the top, interacting with the capital markets, the reinsurance market, is more expensive vis-a-vis having your own reserves, contingent credit, depending as to where you get it from. If you can get concessional credit from multilateral organizations like the World Bank, then it can be cost effective. It doesn't have such a huge impact on your future liabilities. If you get it from the private sector, again, if you've had this arranged in advance, you will find that it's cheaper than credit you can access after the event. So just a few considerations that we certainly keep in our mind when making recommendations as to which instruments for what level of risk. So this is where I start to get into the nuts and bolts in terms of the disbursement of funds. So this is the case of Fondon. Fondon was ultimately the gold standard. Essentially, because they're highly exposed to earthquake and hurricane risk, they were very keen to have something in place to help them financially respond. They focused in on the cost really of recovery and reconstruction. And they needed quick access to those funds. They also wanted a structure in place which was accountable and also predictable. So what they did was they established an off-budget government unit which held a sovereign fund to finance reconstruction and public infrastructure. And that fund received 4% of the budget each year. In order to be able to cover essentially the cash component, which would be needed for the immediate response, but also to facilitate the purchase of insurance as well. So when I'm saying to facilitate the purchase of insurance, basically that fund held the, what we refer to, again, going back to the previous diagram, held the first layer of loss. In cash in order to be able to ensure that the insurance was affordable and that it would attach at a higher point. And when I'm saying attach at a higher point, meaning that it covers the higher magnitude to try and make it more cost effective. My favorite bit about the Fondon was that it had a rules-based approach. It would cover all of your losses if you didn't have insurance the first time there was a disaster. If you didn't have insurance and you were impacted by a disaster for a second time, it would cover 50% of your loss. If an event happened a third time and you were very unlucky and you still hadn't purchased insurance, you received no funding whatsoever. So they created incentives in order to ensure that people purchased that insurance. This goes back to the data and analytics slide. This is some work that the team that I own, this is what we do. What we try and do is, again, leveraging the information that we went through last week from risk modeling, we try and use the outputs of that to help quantify how much you should hold in each of the different financial instruments. And Christina will demonstrate this with the funding gap analysis. What we can also do is develop tools which can show you how different policy choices and having different amounts of finance through different instruments can impact the amount of cover, financial cover that is, that you have against disasters of different magnitudes. So it's quite a nice way to demonstrate it. We can also look specifically at the cost of instruments as well. But again, I won't dwell on this one too much because Christina's actually going to walk you through a very practical application of this. This is an example of one of the bespoke tools that we do. Essentially, you can set the amount of different funds, how much finance you're wanting to give to people, and so on. And this will give you your initial quantification as to how much finance you need, and essentially an indication of cost. This is my last slide. So I've given you a very quick overview of the fundamentals of disaster risk finance. We do actually have an online course, which I placed the link to here, which will run you through the full cohort of the fundamentals of disaster risk finance. For those of you that are interested in learning more about how to apply the data and develop some analytics, we also have an introduction to disaster risk finance analytics. This was actually financed by DevCo within the EU. I've also placed the link here as well. For those of you that are interested, you can go and take a look at that. And for the absolute enthusiasts, I've placed here the Financial Protection Forum. Please go and take a look there. We have a lot of information that's on this site. We're very happy to add you to our community of practice, which would mean that you would receive a weekly letter as to the latest developments. These can be market developments, it could be products that we've developed. Essentially, it's something we definitely recommend. But as I say, for the absolute enthusiasts, because you will get a weekly email from that one. I saw a question come through. Gaetano, did you want me to address the question before we move on?
I was going to. I hope you can hear me.
Yep, can hear you.
Okay. Question from Nestor from the OECD. Whether you also look at post-disaster performance of different instruments. That's, I think, quite interesting. Do you do this as part of your analytics?
So, strictly speaking, no. However, where we can, we try to. And I give that answer specifically because it's not always very easy to understand how the finance was used. It depends on the structure of the government budgets and being able to see that translate into specific expenditures. But we definitely try, because what we try and do when we can get access to this information is to use it as a feedback loop to inform the design of the financial instruments themselves. So it depends as to how much of it we can see. So it's a bit of a yes and a bit of a no. So sorry for for having a foot in both camps there.
Okay, and then if you could briefly address the question from Mark, which is it's a very good question, but it's a bit the aim of the whole course of today. With the fact that we don't have in EU member states a common approach to a common strategy for financial protection, and what model, in your opinion, could be a standard to follow?
So again, goes back to the point. What do you want to finance, and how do you want to finance it? What really are your priorities? And this is something that I think the EU Solidarity Fund has started to articulate. So there are some clear rules in the game as to what the Solidarity Fund will finance. But I think what could be of benefit to the EU is seeing how they can complement what the Solidarity Fund covers, either through adding financial instruments on top of the Solidarity Fund to cover these additional aspects or to provide additional finance towards them. or whether to consider additional instruments at the EU level. And we discussed this extensively when writing the report. I think having that clarity as to what the EU will finance vis-a-vis member states, I think will be very important. I think there's a need to coordinate. So yes, I think visit the strategy at the EU level. You were asking specifically for kind of a standard example. We don't really have a standard one. I do really like the example of the Fonden. I think it works quite nicely. I think there are lessons to be learned there, particularly for the Solidarity Fund and through the addition of extra instruments, for example, a cat bond or something like this. But I wouldn't look at it in isolation from the member states' strategies as well. Particularly one of the findings of the report was to do with insurance. I think being able to advocate for insurance, particularly insurance of public assets, if you can advocate for that at the central EU level as well as at the member state level, I think that would be highly beneficial.
Thank you, Samantha. I was also, I must say, personally impressed by that figure that you showed at the very beginning on, every year 10% of chances that all the reserve funds that we have in member states and in the EU, considering the Solidarity Fund, may be completely exhausted and wiped by only considering earthquake and floods. So 10% of chances every year. And we're only looking at two of many hazards, not to mention, the relation between them and, potential complex hazard, cascading effects, etc. So really, a little, I would say, also worrying news out there for us in the EU. I don't see other questions or comments. So I guess we could go to the actual results of what we have a comment. Yeah. So also a little follow up from Mark. But I guess we have no more questions. We could just go into the results of the macroeconomic modeling. So I guess over to Maria.
Thank you, Gaetano. Can you hear me well, first of all? Is the connection okay? Okay, great.
Yes, we do.
Thank you very much, Samantha, for the introduction. And I, today with my colleague, Dan, who will be presenting with me, we're going to talk a little bit about one aspect of this work, which was the macroeconomic modeling. And really what we were trying to do with this model is to capture the impact of disasters over the next 30 years, and specifically their impact on the economy, on the GDP, and also the fiscal budget. And one of our goals was really to apply consistent methodology across all of the EU member states, and one that uses insight from the risk modeling, which Stu presented last week. So next slide. A little bit of motivation behind this work is that we know that disasters across the EU cause significant impact on the economy and government expenditures, and governments do bear a large portion of the financial liabilities. From previous disasters, we can see that at any particular year, just from weather and climate-related extreme events, losses in the last 20 years can go above 50 billion euros. But when we talk about kind of not the cost and direct impact of disasters, but how it affects the economy and the production, measuring that can prove to be quite a challenging task, and actually isolating and tracking it because of all the numerous factors that drive the economy and all the different factors that go into the changes. So one way which we have thought about this is really to try to model explicitly the impacts of disasters, while a lot of other factors remain the same, to really try to understand how much indirect impact we have beyond just understanding the costs and the damages. Next slide. So these really drove the objectives of our study, and the first one was to understand the impact of local future disasters, so single events, on the economy of different member states and also the fiscal sector. but also how these losses trickle up and turn into liabilities across different stakeholders who will be liable for paying and covering those losses. And also we wanted to incorporate how the different risk financing instruments that Samantha talked about, how they affected the liability, these liabilities. So the model in general was a multi-layer model that incorporated, I would say, several separate layers and build one on top of the other. And at the base is really this disaster risk assessment, which I will briefly recap. And today specifically, we'll be talking about flood and earthquakes. But then using that as a base, what we're really trying to simulate is the next 30 years and the losses and the events that will happen in the next 30 years across the different countries. On top of that, we need to define a risk financing structure for each of the countries and some rules, especially into the model, of how things get financed. And I'll talk a little bit about that. Now, after that, we do run a macroeconomic model, an adjusted Solon-Swan model, which we will discuss a little bit later. And finally, we have a fiscal module that looks at expenditures and revenue and fiscal deficit and also public debt and how that all incorporates. And then finally, we can then quantify the different factors and different factors of interest across different countries, but also in aggregate for the EU. And next, if you kind of remember, the whole first part was the subject of the technical training one. So please, next slide. So the base layer, just to recap, was a disaster risk assessment, and it kind of has several, as Stu mentioned last week, several components that are considered, and this was really considered in our analysis. We look at the underlying phenomena, the hazard in flood and in earthquakes, the likelihood of different events happening, different flood events and earthquake events. But then, of course, the model has to consider what is at risk, the exposure, both in terms of social, so people, but also different physical assets. And we typically look at financial losses, the financial value of these assets as well. And then the vulnerability part of the model is, of course, how likely it is that these things that are in the way of the hazard, how likely is it that they will be damaged and destroyed? And so through aggregating three of these kind of components, we're then able to look at the potential losses, but also their likelihood. And this aspect is key because, of course, there can be many different events that happen, many different outcomes, and they are surrounded by a lot of uncertainty. So when we talk about the potential outcomes of disasters, we have to consider that there is no one true number. Really, there's a large uncertainty around these events, and in this analysis, we actually did a probabilistic analysis. So we considered all possible events, flood and earthquake events, plausible damaging events, and the likelihood. So next slide. So as a result of this analysis, of the risk analysis, we have quantified the losses for earthquakes and floods across the EU member states over the next 30 years. And what do I mean by over the next 30 years? There were different dynamics that were considered in the model. One of them is the changing hazard for the flood risk. And the changing hazard, of course, considered one of the climate scenarios, and it is based on the change of return periods of different events, different extreme river flow events. And what that means is that we're essentially allowing the model to understand that the frequency of different size of events will be years. But on the other hand, we also know that a lot of the urban centers are changing, that there is urban growth and evolution of the building stock, which will happen in the next 30 years. And so that was done through a dynamic exposure model, which modeled the population and building stock evolution over the next 30 years. Man-made drivers, but also some natural drivers of the expansion. So a very brief recap. You have seen again last week on the seismic economic losses at kind of a local level, both in terms of monetary value, but then also in terms of relative value. If we can go to the next slide.
Maria, sorry to interrupt.
And then losses. Yeah.
Sorry, I may have a bandwidth issue, so perhaps you may want to, because you've been breaking up your audio, so you may want to switch off the video. Yeah.
Okay,
Sorry.
is it better now? Apologies.
For now, it seems fine. Yeah, go ahead. Sorry about that.
Okay, please let me know. Please let me know. Okay. If all right, so one thing that is important to note here is that that different types of assets were modeled. So residential assets, losses to them were modeled separately from commercial, education, healthcare, and industrial assets. And we're able to kind of use this breakdown in the economic modeling. We're also, in addition to getting average losses per year, we can also look at the events that are for the different return periods. So now we're starting to say, well, what will happen if we consider a less frequent event or a more frequent event? Next, please. And a similar exercise was done for the flood events across the EU. And again, I think one important takeaway from these analyses is that we can look at absolute values and we can look at relative values, and the scale and the ranking of impact can be quite different because the losses do depend on the amount of exposed value that is exposed. So I think it's important to look at both and trying to understand the impact of these different hazards. Next, please. So for the flood events, we also quantified the losses across the different countries. As you can see, in terms of absolute terms, Germany and France are the most impacted in the model. And one thing to note for both floods and earthquake is that the residential sector does bear the highest losses across the different sectors that were modeled. And this is in line with what we actually observe happen in different disasters. And in this graph, you can also see that we do have approximately a 25% increase in average losses looking at 2020 to 2050. So this will be kind of an important factor when looking at the evolution. Next slide. So then once the risk assessment is complete, our next job was really to look at simulating the different separate events of disasters for the next 30 years to kind of generate these different paths of what could happen over the next 30 years. And to do this, to consider the uncertainty, we've simulated 1,000 simulations based on the risk results of earthquake and flood events over the next 30 years. And then for each year, we consider damages in residential, industrial, commercial, health, education, and public assets, but also considered the emergency response cost, which was, of course, dependent on the size of the event that happened. And then after that, we really looked at the liabilities across the different stakeholders. And here on the right, you can see an example of the different simulation path. This is cumulative loss across across the next 30 years. And each of the thin gray lines really represents different paths. And you can see that they can range from over the next 30 years, for example, as an example for Austria, below 10 billion to nearly 70 billion across different simulations. And so this range is quite big, and this is where the uncertainty becomes important. So now, how in our model, how do these losses trickle down to the, how do they actually get financed, and how do they get trickled down to liabilities? And this is really a summary of the risk financing structure, where at the top, you have the different types of losses and costs that I've presented. So in blue are the government related costs, finance costs, such as emergency response costs and public assets, residential sector losses, and private sector losses. So the first layer in the model of financing is really the insurance of public assets, residential assets, and commercial assets. Then on the public side, we have several risk financing instruments that Samantha mentioned incorporated, such as reserve and general contingency funds and the EU Solidarity Fund. And on the residential side, we also have government assistance. So how much will the government pay for the liability for the household liability? And so as a result, combining all this, we get net government liability, household liability, and private sector liabilities. And we can also see what part of the losses is financed by insurance. So finally, how this all looks together is really that we have our losses. Now we have 1,000 simulations of flood and earthquake events in the next 30 years. And these direct losses go then into a macroeconomic and macro fiscal model that is run for each of the 27 EU member states. For that model to run, we need two things. We need to define the risk financing input structure, and with a lot of data from the different member states. And we also need to define a lot of the GDP-related economic input data. And then as some of the outputs, we get GDP projections for the next 30 years and the different fiscal variables for these 1,000 simulations. And then as a result, we can look at different statistics from these simulations. Next, please. And so that core part that you saw, the actually economic macro fiscal block, has a flow within itself, and so the job is to translate the damages in capital stock into the real sector of the economy and really look at this impact on the GDP. And there's kind of three ways in which this shock propagates into the model. First of all, we have reduction and destruction of productive capital. And so the output, the economic output is decreased through that mechanism. So the GDP decreases because of the damages that the disaster causes. But then there's two other mechanisms that are at play. One is because of this reduction of output, we're also seeing reduction in revenues through taxes due to the decrease in GDP, and we can capture it in this model. And then the third effect that we see is really the increase in expenditure due to the government needing to finance the liabilities. And that, of course, has an impact on the fiscal balance in the model. So I'll let my colleague Dan talk a little bit more about the Sol and Swan model and the results that we got from the analysis.
Thank you, Maria. Just with apologies to Dan, if I could just come in with two questions from Nestor from the OECD. The first question is about whether it's possible to analyze how much of those losses have to do with vulnerability, with actual lack of coping capacity. And so that would be the first one. And the second question is from Nestor is about when for low probability, high impact events, the government is itself the last resort, insurer. So it's difficult. It may be difficult to draw a line between the government liabilities and the private sector liabilities. So how do you assess those specific cases when? when the government may, in any case, foot the bill. Maria?
Yes, sorry, Gaetano. I'm having a little bit of bandwidth trouble on my own. Maybe I can. Are these comments in the chat?
Yes. Why don't you provide a short response in the chat, and then we go to Dan for continuing the presentation, if that's okay with you?
Yeah. Thank you. That
Okay,
works. Sorry.
great. Over to you, Dan.
Okay. Thank you, Gaetano. Thank you, Maria. I'm going to present now some more, say, details, maybe not too technical details about our macroeconomic model. So basically, to assess the impact of natural disasters on macro and fiscal variables such as GDP, revenues, expenditures, public debt, and so on, we use a standard Solos-1 growth economic model. Basically, we are using, and you will see right after this slide, we are using a Cobb-Douglas production function to capture the impact of disasters in the real sector of the economy. Then this impact in the real sector will be translated to the fiscal sector. Some words about why we choose this classical Solos-1 model. This model allows to building on simplicity to understand the impact of disasters, and can be easily implemented even in Excel. This is how all the process started. For instance, in Romania, we had a 2 years collaboration with the Ministry of Public Finance, where this model is implemented. And now we escalated and raffinated this model at the entire European Union level. What is a model? I think everybody knows, but just a short remember. Macroeconomic and general model is just an analytical tool to replicate the operation of global and individual countries' economy. Why do we need models? We need models to have a better understanding of past and future economic trends. Also, we need decisions which are data-driven, and they are driven by risk analysis and economic outlook. And also, once we have a model, we can test a series of scenarios, a medium scenario, optimistic, pessimistic scenarios, in order to choose the right decision, the right economic and policy decision. Next slide, please. Okay. This is the famous classical Solos-1 model, which attempts to explain the long-run economic growth by looking at some factors like capital accumulation, labor, population growth, increases in productivity, and so on. Maybe all of you know this famous formula. IT is the output, which in our case is the GDP. K is the capital, L is the labor factor, and we have there the parameter alpha, which is the elasticity of output with respect to the capital. Okay. Next, please. Apart from this general model, we have a more specific model in our case. So basically, we are considering a Cobb-Douglas production function. You will see there in the first equation. Then we took into account the evolution of the capital. So basically, year after year, we should consider an accumulation of the capital with some depreciation rates. Plus, we need to take into account the dynamics of population and labor market. And in the end, we can identify the growth drivers using this decomposition. So basically, the output growth can be determined by using the total factor productivity growth, capital growth, and labor actually is the human capital per worker. And also in this model, we can include the shock caused by disasters on the capital stock. The last equation here, you can see that at some point, the capital may be diminished by some proportion of the shock transmitted to the capital stock. Okay, and the capital stock then it's rebuilt according to the investment rate. Next, please. Okay, so that was the model for the real sector. Now, starting from that model, we can go to see the fiscal sector impacts. So basically, the natural disasters can have an impact on the public debt through the primary balance, which is influenced by revenues and expenditures. And on the expenditure side, we define government liabilities taking into account losses produced to non-insured government assets, losses produced to non-insured residential assets, and also we took into account the reserve funds and the European Union solidarity funds. Okay. Next, please. As input data, we used a lot of economic and financial data for European Union member states. So basically we have population, we have percentage of population age 15 to 64, labor force participation rate, GDP, GDP deflator, real and nominal GDP, government revenues, government expenditures. Some of the data sources are Eurostat, as you can see. The other ones are World Bank. The time period included in this study, it's 20 years, so from 2000 to 2019. Okay, so basically the COVID, it's a little bit undercover, let's say. Okay. Based on this model, in order to see the impact of natural disaster on the economic and fiscal side, we define two potential scenarios. Scenario A, which is a low liability scenario, where the government would cover, and so basically he will reconstruct, let's say, damaged housing of low-income uninsured households. He will reconstruct all the public assets and will cover all the emergency response costs. The second scenario, so a high liability scenario. In this scenario, the government is expected to reconstruct housing of all uninsured households, to reconstruct all public assets, okay, and to cover the emergency costs. Under both these scenarios, we exclude commercial and industrial losses from the government liabilities. Again, this may not be a very realistic assumption. We will discuss further about the limitations. Under these two scenarios, taking into account those simulations Maria mentioned, this is the distribution of sector liabilities for every general losses. So in the first scenario, low government liability, the government is responsible for almost 34%, 35% of all losses, while in the second one, 64%. So you could see that, of course, we can design several scenarios, or we can look at a particular situation of a country. But you see the difference between these two scenarios. The insurance in the first scenario can take 24%, while in the second, 60%, and so on. Next slide, please. Of course, the impact of disaster is not uniform across the member states. This may depend on the economy, on the GDP, on the, let's say, prearranged reserve funds and so on. Anyway, in the low liability scenario, and without taking into account the BRF instrument, the impact can be as high as 0.5% of GDP, Bulgaria, where for the other scenario, the high liability scenario can be as high as 1%. And this is just an annual average. Okay? The EU level average, as you can see, it's 0.1% in the first one and doubles in the second one. Next, please. Here we have some major results of the macroeconomic model. First, the first conclusion is that if we consider a major disaster, let's say one that occurs in 100 years, the impact of such a disaster can exceed 7% of GDP or up to 17% of GDP in high liability scenario, which is huge. The emergency response costs can range from 41% of total government liabilities to 22% the high liability scenario. What from this finding, maybe there is a need to implement some instruments to provide quickly finance. Another conclusion is that liability generated from public and housing assets accounts for roughly 60% of total liabilities in low liability scenario and 78% in high liability scenario. Okay. And again, there is a need to improve the availability of financial protection for these assets. And another conclusion is that there is no significant correlation between the size of reserve funds and contingency funds of EU member states and the fiscal impacts of disaster. So we may have countries with huge reserve fund, but the fiscal impact of disasters may not be as high as for countries with low reserve funds. Next, please. Now, we should discuss a little bit about model limitations and future developments. Because after all, a model is just an approximation of the reality. And there is a famous quote from George Box, a famous statistician in time series analysis, that all models are wrong, but some of them are useful. In a sense that a model can be a useful approximation of the reality, but cannot perfectly describe the reality. And that's why our model, of course, has some limitations. Some of them are data related. Other limitations are related to the hypothesis. We are using the first limitation may be induced by the fact that we are using 20 years of data and we are making projections for the next 30 years. So these may be first major limitations. And in fact, as a time series, our variables are not homogeneous. And this is especially to this COVID-19 pandemic. Also, it is important to mention that our model has several assumptions related to the real and the fiscal sector of the economy. If we are talking about the real sector, the main assumption is how the natural disaster impacts the stock of productive capital. So basically, we are assuming that 70% of the of the impact is transmitted to the productive shock, which may not be the case. So we are assuming that this impact is uniform across all the sectors, across all the industries and so on, and also across all the countries. Okay, so this is a hypothesis that maybe in the future developments needs to be revisited. Also, the percentage of the negative shock of a natural disaster can vary significantly from country to country and also from industry to industry. And we can solve this problem in the future by applying the model, not as a whole for the entire national economy, but by using sector-specific models. Next slide, please. Okay. Another limitation is an internal one. The Cobb-Douglas production function. So the function itself is quite non-sensitive in a sense that the impact of a substantial capital loss may be reflected in a very low output loss, depending on the initial capital stock and also on the parameters of the production function. Also, maybe there is a capital stock threshold below which the production takes significantly longer to recover. Let's imagine that we have some floods. We had actually in Germany, and suddenly 90% of the highways are destroyed. Okay. Of course, this will have a significant, huge impact on the entire economy. On the other hand, if we take, let's say, Romania, if 90% of the highways are destroyed, the impact will be significantly low, because compared to Germany, the length of highways is significantly lower. Okay, so maybe we should introduce a threshold for the capital stock. Of course, we can for the future developments, one of the recommendations from the reviewers was to augment the production, the Cobb-Douglas production function, by using the average productivity of the capital. And by using this method, maybe we can see a higher impact on GDP due to natural disasters. Next slide, please. Okay, and also for future developments, in the current model, there is an issue with the way how the impact on public debt is reflected by the model. Okay, because somehow we need to take into account the impacts associated with higher government debts. And we have an example here, crowding out of private sector investments via higher interest rates. And also, we need to take into account the impact of disaster funding speed and availability. Because it's clear that we don't have enough funds, then the recovery process will be delayed, and also we will have long-term economic impacts. Next, please. Okay, that's it. Thank you very much.
Gaetano, you are muted.
Thank you, Judith. Yes, we are. Thank you, Dan. We are running a little bit behind, 10 minutes, I think. So we may have to move to the next session. But and I also want to thank Maria, who meanwhile very efficiently provided a response in the chat. We have a question from Gianluca, which I'll try to summarize. To you, Dan, adding a component of human capital destruction due to the victims of disasters would help endogenize the particularly sluggish recovery in their aftermath. How
Actually,
could you briefly respond to that?
Actually, thank you for this idea. This may be a good alternative instead of losing the threshold for the capital. We need to test, of course.
Excellent, but happy to see that this is a really an interactive workshop, so we can build also on ideas from participants. Thank you, Gianluca. I would then go next to Christina, if I'm not mistaken, for the remaining part of the presentation.
Yes, thanks, Gaetan.
Over to you.
And hi, good morning, good afternoon, everyone. Very happy to be here presenting the results of our work. So my part is going to be focusing on the funding gap analysis. The other kind of analysis that we could be doing with the hazard results, the very detailed hazard results for flood and earthquakes. And we have done that for all member states and also EU as a whole. And then I'll walk you through together with Maria on the exercise that we have done using the results of the survey. Next slide. So the funding gap analysis was really aiming at looking across all member states of the European Union at comparing the implicit and explicit liabilities, so the needs for the government to fund after a disaster, funds dedicated mainly to relief and recovery, so we are not touching that much on the pure reconstruction, with what is available at the level of each country, but also at the European Union as a whole to cover for such expenses. These funds don't come as free funds, right? All of these funds will have a cost implicit. Some of them will have a rate of interest. If we are talking about, for example, contingent credit lines, if we are talking about insurance, there will be an insurance premium cost that has to be borne by either the households or the government. And also there is an opportunity cost aspect for all the ring-fence funds that the government could set aside in national disaster reserves to cover for future disasters. However, before we look at the available funding, we should start by decomposing what is the government liability. And Maria already touched upon this. I will come back to it and explain how we have done it for the funding gap analysis. So we did start from asset losses, but we were able to break them down into, as you've seen, residential, public sector, commercial, industrial, and also strategic sectors such as healthcare or education. And all of these were taken, some of them in a variable proportion. For example, the residential asset losses, we assume that a part of the uninsured residential asset losses will fall under the government liability. What is that proportion is a very important question, and we could be thinking at using the poverty line in each country as the minimum proportion the government could be covering. But we could also imagine a situation, extreme situation, where the government would cover all uninsured residential losses. Then the public asset losses we assumed will fall 100% under the government liability, and so will the strategic sector asset losses, so education and healthcare. There is a type of cost, which is the emergency response cost, which is really the cost that's incurred immediately after a disaster occurred, and it has to do with evacuation, it has to do with debris removal, and this we assumed 100% falls into the government liability. And you see in shaded blue the emergency social protection. It's an aspect that we are very aware that it needs to fall and will fall in government liability. It's, however, not part of this study. So we really only focused on the asset losses and this emergency response cost. That's how we created the government liability, the cost of disaster. Next slide. So we have followed all member states, all 27 member states. However, we have 4 focus countries that we will present a bit more in depth today: France, Austria, Croatia, and Romania. And these countries have been selected for different reasons, but they are a good demonstration of either very strong insurance penetration or a very strong national reserve fund, a very strong profile, if you want, of the hazard, but also having contingent credit lines. So each of them has a specificity that was interesting to look at and see where that places them in terms of drivers of government liability. So on the left side, if you look at the first graph, what it tells us is how much from a total given loss for a disaster is borne by the government as government liability. And for example, you see on one side of the spectrum, you have France, where 37% of all the loss, on average loss incurred after a disaster is borne by the government. And the reason for France having such a low rate is they have a very high penetration of insurance. In the household insurance is at more than 95%, and it has been mandated by the government, but also supported through mechanisms where the government also steps in as an ultimate reinsurer. And so it takes a bit of the share of the burden for the insurance industry as a whole. So it's one way of improving the insurance penetration rate, but also the fact that France has a lower poverty risk. So if we think of the government as being mandatory covering the poverty, everything that is below the poverty line, in France that poverty line is pretty low. On the other side of the spectrum, there is Romania, where we have the highest government liability, the total loss at up to 80%, more than 80%. And this has two reasons. First, it has a very high ratio of publicly owned and uninsured assets, which means that it will need to cover all those at 100%. And also it has a very high share of households at risk of poverty. So these two countries are at the extreme ends. On the right side, you can see what is the share of the government liability, but comparing the poverty line. So you see again that Romania is on the higher spectrum of the poverty line, and the penetration rate of insurers. It just supports what conclusions I have. Slide. Looking at what DRF instruments, what disaster risk financing instruments are available to governments to respond to disasters, I have created this map that looks from the bottom up. It has a portion of risk retention, then a portion of risk transfer, and a portion of other kinds of support, which in this case would be more like donor support after very, very severe disaster. So the risk retention is the part that is really at national level formed at the government level, and is in the government responsibility to use for disasters which will probably be of lower severity but more frequent. We are talking about budget mechanisms such as reallocations or reprioritizations, or funds which are at the municipality level and can be used, dedicated for disasters and used for disaster response. And then moving up a level, we have the national disaster funds, which are the pre-allocated reserves I was talking about, that do have an opportunity cost, but that they are very important in responding to disasters. And on top of that, the government can choose to also procure contingent lines of credit, such as the KDDOs. And one example of a country that had and has a KDDO is Romania, which procured one that was used for a response to COVID, for example. Above the national level results and reserves, we have the EU Solidarity Fund, which is the mechanism at the EU level that triggers support for response for certain types of disasters, for a certain severity of disasters, and it has different activation points for each EU member state in line with their GNI. This is a mechanism that has been used in the funding gap. It was our interest, the interest of the study, to see if it's being used at its maximum efficiency, if it can be improved in terms of activation criteria or in terms of coverage. And I will show you in an instant. On top of that, any government and any country would be interested to procure risk transfer solutions for households, also household insurance against catastrophic events. Very importantly, public asset insurance, so ensuring the assets that are that belong to the government and also the strategic sectors, education and healthcare, but also potentially procuring sovereign insurance, which are what we know as regional pools, where countries could create together an insurance mechanism that covers more than a single nation, and that would disburse funds in case of very severe disaster. The ultimate mechanism, which has very high costs potentially, but also a lot of unpredictability in terms of timing of funds, is the international support. And here we could be talking, as I said, about donor funding that can come in terms of as loans or grants, or but also can be borrowing. And in this case, going to the international markets to borrow after a disaster can be quite inefficient when timing is of importance. Slide. Here, I chose to look a bit again at the 4 countries focus, so France, Austria, Croatia, and Romania, and see how their national reserve compares to the activation level of the EU Solidarity Fund. What's important is here to look at is the layering. I was saying that the national reserves would be used for more frequent but lower severity events, and that ideally after that point there would be the EU Solidarity Fund stepping in and activating. So interestingly, there are a lot of countries, a lot of member states, which have their national reserves very well aligned with the activation point of the EU Solidarity Fund, which means in reality that there will be a lower gap in case of a disaster. Even if their national reserves have been depleted, there will be another instrument that steps in and helps temporarily and for a part of the disaster response. So France, for example, we see the blue bar is the National Reserve Fund, and the EU activation is immediately after. And it also matches nicely with the highest loss for which the country received aid. On the other spectrum, we have Romania, where we see there is a gap between the National Reserve Fund dedicated to responding to disasters and the activation point of the Solidarity Fund. What happened in Romania, for example, the government filled that gap with a CAD-DDO, with a contingent credit line that was really sitting between the reserve, the National Reserve, and the EU Solidarity Fund. For Austria, there is still a significant gap, and it hasn't been filled by any other DRF instrument presently. Slide. Now, going back to the funding gap analysis that we have done for all member states in the EU as a whole, here I'm showing the kind of strategies we wanted to look at. As I mentioned, our focus was the EU Solidarity Fund and its efficiency. We found that it is very efficient and it really fills the gap needed for some disasters of medium severity, really. And for that, we used 3 strategies. So the base strategy is the one from today, where the activation level for each country is the standard one, is defined by the guidelines of the Solidarity Fund. And when it activates, it will cover between 4 to 5% of total asset losses. That's based on average and what we've observed from historical allocations. For our analysis, since we were only looking at floods and earthquakes, the fund has 1.1 billion, but we only took 660 million because there will be other disasters for which the fund needs to activate. So we chose a number that reflects properly the historical allocations, but also the exposure to floods and earthquakes. And this is for the purpose of this analysis. Of course, in reality, the fund can be depleted by one single event. For example, one earthquake could be depleting the whole fund. The strategy B was a testing strategy of ours, where we varied the percentage of losses that can be covered by the EU Solidarity Fund. So we assumed that the fund would cover 50% more than it covers today, 70% more, than it covers today, to see if it would be more efficient for countries. In the strategy C, we varied the activation point. So we said, what if it would activate sooner, but it would cover as much as it covers today, right? And here are some of the results we got for the 4 focus countries. On this first slide, you see France and Austria. So for France, this is the scenario, the current scenario, if you want. And we see that France can withstand only with its National Reserve Fund and the EUSF, the Solidarity Fund, can withstand events of low to medium severity without observing a funding gap, without seeing this red bar, if you want. It's increasing starting at 1 in 10-year events. So with a 10% probability, it will have a funding gap of 1 billion, but it can go up to 4 billion for very severe disasters. Those are the disasters that have less than 1% probability. Austria shows a pretty similar pattern. But because it has less of an exposure to disasters, the gap itself in amount is lower, but it still manifests itself for events starting at 1 in 10 years and building up towards very, very severe events. For very severe events, Austria could be experiencing a funding gap that is close to 3 billion euros. Slide. Now for Romania and Croatia, Romania, as I mentioned, has, as opposed to the other countries, a contingent line of credit that filled the gap that it had in terms of mismatch between the national reserves and the activation point of the EU Solidarity Fund, but also given its hazard profile, being very exposed to floods and earthquakes, it needed such an instrument. You can see that Romania experiences funding gap even with this instrument, even for very small events. So the ones that happen with a 20% probability every year, and it can have up to 2 billion euros funding gap for very severe events, which compared to its GDP, it's very significant. And on the bottom of this slide, we have Croatia. Croatia doesn't have any contingent credit line, and as you've seen from the previous slides, it also has a mismatch between the national reserves and the activation of the EU Solidarity Fund. And so all this implies that it will experience funding gaps in all cases. So in all the simulated events that we had for floods and earthquakes, Croatia shows a funding gap of up to 300 million euros for very severe events, but it can have in any given year at least 10 million euros of uncovered funding for a response to disasters. At EU level, this is the analysis that we did by mixing all 27 countries and also the 2 hazard profiles, the floods and earthquakes. And we wanted to see if we can observe a funding gap also at the EU as a whole. So our base strategy was to use the activation and the coverage of the Solidarity Fund as they are today, and to sum up all reserves at EU level as 1% of all national reserve. And for strategy B and C, we varied either the coverage of the ESF or the activation point, as we did for each member state. So on the next slide, you will see the results. And the results are not very promising. So we observed that at EU level, the financing gap can exceed 10 billion euros in any given year. So the very first bar. And for very severe events, so events that happen with less than 1% probability, it can go up to 50 billion euro. So the sum of all the EUSF and all the reserve funds as they are today, plus contingency funds where they exist, can only cover 4% of government liabilities every year. All this points out to the fact that there is need and scope for more instruments, either at national level. So incentivizing national governments to invest in DRF by increasing the size of the national reserves or being even more creative in terms of the DRF instruments that they use, but also at the regional EU level for more instruments that can cover potentially this gap. Slide. What we have seen is, for example, that increasing insurance uptake by households can halve government liabilities for very extreme scenarios, but also for small scenarios. So the first graph on the right side, you see the red bar is the effect of lower liability, which has also a higher insurance penetration, while the blue bar is the higher liability of government, which has a lower insurance penetration, and it's very close actually to the real loss. And finally, the EU instruments can be insufficient, even though they only cover a small fraction of the response, but this is done by design. There is more need for a national stepping and improving the DRF landscape and the DRF instruments that countries have available for responding to these. Next slide. So now we are entering the final phase, which is the interactive exercise. And probably in the interest of time, I will go through it, Gaetano, or you want to ask some questions? You are muted.
Christina, if you don't mind to break for a couple of questions, just quickly. First of all, we had the question from Galia, who is asking basically if it's possible to use the models that were used for the study and customize the results for a specific country or a region, and that perhaps, I guess, Samantha would be probably best placed for that one. But with regards to your specific point, Christina, Nestor from OECD asking whether you, in your hypothesis, took into account the fact that there can be disasters that affect several member states, and therefore the requests could be done by several countries at once, as we recently saw this summer with the Western European flood. So putting even more of a strain to the Solidarity Fund, so adding even more of a bad news in addition to the one that you just gave us. Perhaps Christina and then Samantha for the other question.
Thanks, Gaetano. Indeed, we have. And when we created the hazard profiles that you have seen in this part of the analysis, those hazard profiles are mixing earthquakes and floods, but not by simply summing up the losses, but by taking into account the independence of these hazards and areas where we know that, especially for floods, there will be a regional impact. So all this has been factored in. So probably I wouldn't be giving you even worse news than you've seen at EU level. And before I'll allow Samantha to answer, but I will say that technically, so from the model side, yes, we can customize even more at country level or regional level. We have all the results and all the data, but I'll let Samantha.
But before, sorry, we're just having Guna, our colleague from the DG Regio working on the EU structural fund, Solidarity Fund, who just asked a very important question. So what would be the ideal size, or perhaps, the ideal shape, if not the, financial size of this EUSF Solidarity Fund? Have you put any thought on that, you or the team?
So maybe I will respond first to the question of the shape, because when we were testing the different activation points, a lower activation point was not always or rarely the answer to filling the gaps, but it is more the discussion and the alignment with countries at national level to make sure that they go as high as they need. And as I said, there are probably now, from the top of my head, I would say 50% maybe of the member states that are aligned, which means it's possible. So it would be more of an exercise to make sure that there is no disconnect. These two elements, the national funds and the Solidarity Fund, are really meant to work together. So making sure that it happens in most countries is probably critical. And in terms of size, I mean, we have indicated the 10 billion, which would be like in any given year, probably the need. This doesn't 100% indicate that this should be the size, right? But it can be an indication that the size might need to be increased. However, as Daniel was also saying, we are talking about models. So if we can personalize the analysis even more, probably we will get even more detailed and more useful results for deciding on the size.
Great, thank you, Christina. Over to Samantha for the other question.
I'm just going to add on to what Christina was saying on the Solidarity Fund first, because what we've done throughout this exercise is ultimately to give an indication of the need, but only the need for earthquake and flood. So bear in mind that if you want to look at the Solidarity Fund holistically and identify a target amount, I do think it would be worth bringing in additional hazards and doing it on an all hazard basis. Then yes, we can certainly demonstrate what would be needed in an average year. However, the decision as to how much to keep in reserve, that would be a political choice. And when that choice is made, we can then advise as to which instruments would be most cost effective, because obviously Christina gave the number of 10 billion euros there. Does the EU really want to hold 10 billion euros in cash? Because there is an opportunity cost associated with that. So I just wanted to point out that it's a very complex issue when deciding how much, and of course very political as well. On the tools, there were no bespoke tools that were developed for this study itself. There are some which were developed by DevCo with our colleagues. However, in order to access these tools, we do request that people complete both the fundamentals of disaster risk financing and also the introduction to disaster risk financing analytics in order to be able to access them. We currently have an outreach program which is ongoing with this. So if there is interest, please reach out to me. And essentially going forward, if there is interest to have a bespoke study for your country done, to have a tool, great, we're very happy to support that. But again, we would need to do it on a demand basis to manage our own workload in that regard. But these are the things we could do. And the reason we ask for you to complete those 2 courses first is there's a couple of parameters that we really like people to understand and have embedded within their thinking before using these tools. And the reasons we ask for that is we don't want somebody to use the tool and think they're going to secure a definitive price from the market, because that's not what the tool is for. Rather, the tool just demonstrates, for example, changing your attachment point, what that could do in terms of impacting your coverage limit for more severe events. So thank you for the question. Great question. Again, no simple answer.
Thank you, Samantha. Perhaps, I don't know if you could we'll put a link in the chat box with this in-depth courses for the enthusiasts, as you said earlier. So those who want to learn more on this and also have access to those additional resources, that could be interesting. And actually, also we have a comment from Inguna, who says that, yeah, actually what happened this summer, the recent disasters that happened in the summer seem to confirm the findings of the models. The study was obviously done before, but yeah, that's a good piece of information that sadly confirms that what we are saying is very likely. Okay, so I think we have now, we're moving now to the exercise. So over to Maria and Daniel.
I will probably start, Gaetano, and then I'll pass it
Okay,
on to
sure.
Maria.
Over to you then, Christina.
So as you've all seen, we have sent you a survey with 3 questions, and the reason was we wanted to show you how we could be building a profile of disaster risk finance for one of the member states, but using really the answers that you gave us. We got a very good set of answers, a very good number of answers as well, which really allowed us to build this interactive exercise. So I want to thank you all again. This exercise really wanted to demonstrate the sensitivity of a member state to changes in terms of its catastrophic residential insurance penetration rate, so moving it up, down, and also the level of losses that fall under the responsibility of the government. We did ask you 3 questions, and the other question was used to really identify what's the closest member state to that your answers indicate. We will not give a name. We wanted to keep it anonymous because what we want to focus on is really these effects, the pull-push effects. You will see it's interesting of the insurance penetration rate and the type of government responsibility and liability that we want to look at. The GDP pattern that we chose is also based on your answers, and we will be looking at 2 scenarios. The baseline scenario is a scenario that for this anonymized member state uses an insurance penetration that is the median that we observe across member states, so a 25% insurance penetration rate of catastrophic insurance, and a government liability level of 15% of uninsured residential assets. And this is matching quite closely the average poverty rate across the EU. Now, the desired scenario, we called it desired, is the one that's using the answers from you. So your answers that we will look at immediately indicate a 50-50 scenario. So 50% insurance penetration rate and 50% share of government liability from the uninsured assets. You see the graph. We have built the profile of the government liability based on this, and you see the red bar is the total loss, and then the yellow bar is the baseline scenario, the 25-15, while the gray bar is the one based on your answers, the 50-50. And you see that both of them are significantly lower than the loss, and this clearly has to do with the fact that there is insurance, but also that the government is not covering 100% of the loss, right? So question 1, this was us asking how much you think the government should be liable for in terms of covering uninsured residential losses. This is probably the hardest question, and there is no good answer or bad answer because it will really depend from country to country, and it will be a political decision, a strategic decision. However, these are the answers, and clearly the 50% is the one to which the majority of you responded, but we also had 75 and 25% pretty close by. But we chose to use this 50% for the desired scenario. Next slide. Now, question number 2 was, what do you think is a realistic target? And I say target because there are a lot of countries which are not yet showing a very good penetration rate of catastrophic insurance. What's a realistic target for across the EU member states for the next 5 years? And here on the left side, first you see the real penetration rate, the current penetration rate based on the current data we had and that we used actually for the study. The blue dotted line shows the mean of your answers. So you see that we have a huge variation across the EU. We have countries where insurance penetration rate is 90 or more, and we also have a lot of zeros or a lot of 10%, which all this ideally would be at least jumping up towards this desired view done by the median of your responses, which would be a 40%. However, the majority of the responses were around 50, which is also what we used in the desired scenario. But just to show you how far or how close we are at each EU member state from that target. Final question was, how much should the government dedicate to building a national reserve fund as a percent of GDP? And this is the one that we use to identify our anonymous member state. You see clearly here there is a closer, I would say, median and mean from your answers to what is the reality. And it's around 0.25%. That's the median, that's the mean, sorry. That's the mean of your responses. And again, we have countries where it's far lower, but they also have very high GDPs. So it's not always easy to use such a number and say it's again, it's a good or a wrong number. On the right side, you have your answers. So now, next slide. Using all of this, I'm recapping what's our baseline scenario for this exercise and what's our desired scenario. So the baseline scenario uses a member state that has a disaster reserve fund of 0.25% of its GDP, has 25% penetration rate of household insurance, and the government is expected to pay 15% of the remaining uninsured losses. It has no contingent credit line, and the EU Solidarity Fund activation point is aligned with its National Disaster Fund. The desired scenario has all of the above, but it only varies the household insurance penetration, moving it up to 50%, and the government liabilities, 50% of the remaining uninsured households. And these are the results for the funding gap, and Maria and Dan will discuss the ones for the macroeconomic analysis. So for the funding gap, this country will have a funding gap starting at events that have at least 10% chance of occurring. So you see that for 1 in 5 years events, so small events are not displaying a funding gap. This is the baseline scenario on the right side, on the left side. On the right side, the desired scenario shows that, however, the country is using more the Solidarity Fund. So with a higher government liability, it will use more the Solidarity Fund, and it will also have higher funding gaps because the government is covering so much of the remaining uninsured assets. So for very severe events, the depth of the funding gap, we could consider it's pretty similar, but in amount, the government liabilities is pretty different, of more than 1 billion. Also, in the desired scenario, where we have 50% penetration rate and 50% government liability share, the Solidarity Fund reaches its cap sooner. So in the first one, in the baseline scenario, the Solidarity Fund reaches its cap only for events that have 1% chance of occurring or less, while in the desired scenario, it reaches its cap already at events that have 2% or less. So all this means that a higher rate of insurance penetration is not the only answer to fully compensate when there is a desire or a need for a significant intervention from the government side to cover residential losses. Back to you, Maria, I think.
Thank you, Christina. So we did a similar, kind of the same two scenarios in the macroeconomic model. And as Christina mentioned, we saw two forces at play. When the insurance penetration was increased, of course, the liabilities for the households decreased, so they had to pay out less. But at the same time, within the desired scenario, with increasing government liability to pay for these household losses, you're seeing an increased government liability in that sense. So over here, this table summarizes quite a few parameters, but some, unfortunately, I can't quite highlight them. But I think the general trend that we're seeing is in terms of government net liabilities to GDP is that they're actually increased in the desired scenario. For the average annual scenario, this increase is by almost 0.1% from the baseline scenario. And for a more rare event, in particular, a 1 in 100 year return period event, the liability as a percent of GDP increases by 0.3% from the baseline scenario. One thing I want to note when trying to, in the report and looking at these results and trying to interpret them, is that what the average event signifies is not necessarily something that we're going to be seeing across each event. An average annual, let's say even liability, is a weighted average of possible things that can happen. But the probability of actually seeing it that exact amount next year is quite low. You are likely to see either no event or lower small events, or a very large event that will actually exceed that. So I think in interpreting a lot of these results, when we talk about average annuals, you have to keep that in mind. And often we look at these 1 in 10 or 1 in 100-year results. Next slide, please. And so this is the pie chart that we saw before that describes the share of different liabilities among the different stakeholders for the baseline and the desired scenario. So as I previously mentioned, you're seeing the household kind of liability pie decrease significantly from 30% to 12%, and the insurance pie increase. But also you're seeing the government liability side increase because now we're covering more of the household losses or household liabilities from 31% to 37%. And this government liability will have to be financed in addition to the reserve and contingent funds and EU Solidarity Fund through ad hoc means such as borrowing or budget reallocations. So I think this exercise really shows what's possible to look at with such tools, what possible scenarios you could look at. I think, especially with the macroeconomic tool, a lot of different questions can be asked. It really depends. We're just scratching the surface of the breadth of analysis that was done and the insight that you can get and the different scenarios that you can play out.
Tana, did you want to jump in, or should I give the closing remarks and then we can continue?
Go ahead, Samantha.
Okay, great. Thanks, Gaetano. Thanks, Maria, Dan, and Christina, all for your fabulous overviews of work, which is incredibly complex, and it's really quite difficult to digest and translate it down to a simplistic level. But I think all three of them did a really good job with that. So closing remarks, I will keep them brief because I prefer to allow time for questions. Essentially, what we want you to walk away with is the conclusion that prearranged finance can help manage the financial and economic impacts posed by disasters. Your responses to the survey, they've just demonstrated that quite nicely, increasing insurance penetration, having that kind of 50-50 split, which is how it seemed to play out between public liabilities and then transferring over across to the insurance sector. It seemed to work quite well, and you saw those numbers feed through. So essentially, today what we've covered is how catastrophe models can feed into economic analysis, understanding that economic impact, and then also beyond the economic impact, also looking at that funding gap more specifically as to where you could target financial instruments to help reduce that funding gap. Again, bringing money in when needed, not necessarily holding it all in cash. So we basically wanted to build an understanding of the financial and economic impact. The reason we want to do this and the reason we think it's worthwhile is this enables evidence-based decision making. So I believe it was Nguna's question, very much spot on. How can we use this vis-a-vis the European Solidarity Fund? How can we target it? I appreciate that neither Christina or myself gave a very direct answer to that, but again, it's because it's so complex, and again, my preference would be to have more information to build upon what we've done just now. Maria's words, really this analysis is just scratching the surface. We would love to work more with you to answer more specific questions, and when we do work more closely with you, that's then when we can start talking about how and when to secure private capital when it's needed most. So ultimately, last real point is inform. Basically, we want to use this analysis to inform the design of policy levers to drive change. We want change on the back of this. Essentially, long story short, investments aimed at achieving and integrating multiple objectives for your financial protection make technical, financial, and social sense. So if I can manage to go to the last slide, in the next session, what we will do is talk about those specific investments and looking at the benefit cost analyses which were done again as part of the larger study to really get an understanding as to what your expected return on investments in disaster prevention and preparedness can be. So with that, that's everything from our side. So all that's left for me to say is thank you. I shall pass it back to Gaetano.
Thank you, Samantha. Thank you, the whole team. This was great. We had also today an incredibly high number of participants, which really shows that there is a demand for this type of knowledge. We are very, very grateful to the entire bank team for giving us the time and the support with this work. As you said, finance is not the only response. Next week we look at physical resilience and investment. So I hope that many of you will join us for the session, same time, same place. And Judith has put in our chat the email address through which we are happy to receive feedback, comments, questions, any suggestion you may have. And that's all for me now. Thanks a lot, and stay in touch. Thank you.
Thanks, everyone. Have a good afternoon.
Thank you very much.
Thank you.
Thanks, everyone. Bye-bye.
Thank you. Thank you.
Over.